We're joined by Stephen Lee, Logan Capital Founding Principal right now. And Stephen, when we look at it, it's been happening for a few weeks as we've seen the yield on the 10-year continue to rise, the highest we've seen there since about a year. So talk to me about what your expectations are moving forward relative to cyclicals and tech and how investors should be playing that.
Yeah, and if you think about it, a lot of this, be it the higher interest rates or the broadening cyclicals, is really reflecting an increasing reality that the economy is getting better. We've certainly had a lot of stimulus about a year ago, which is finally starting to hit. As you were talking about earlier, the progress on the vaccines, the consumers are starting to get out there. And so what we're seeing is a little bit less of a rotation, but actually more of a broadening out into the more sensitive names. So we think of that as you're moving away from kind of providers and offers of technology, who we think are still okay, to really the savvy users of technology. Think about what's happening in some of the retailers that could use technology and meet their customers where they were, whether they're more inclined to be at home or more inclined to leave home, continue to do well. And so we think this is an extension of a lot of trends in almost every industry that were really in place a year ago before we started talking about the healthcare situation. And so we think that leaders between well-managed, savvy users of technology, companies in almost every sector, are really going to continue to do quite well and will be aided by a recovering economy. Certainly, the stimulus we've put at it already before the most recent bills, exceeded what was done after World War II. So there's a lot of dry powder, both in pent-up demand and resources that we think will help.
I wonder if you can elaborate on that a bit more. To your point, when you talk about companies who are utilizing technology in a savvy way, it almost seems like a necessity right now because of the shift that we've seen over the last year. Are there any particular names where you see real growth opportunities right now?
Yeah, and if we looked within companies that have done well, take a Williams-Sonoma. That's a company where management, the CEO, she had really spent a lot of time digitizing that entire business so that they could make that sale at home, in a store, online, using their sales force through video. They digitized all their products so you could actually see it in your living room, even when you were there, without leaving the store. So we think companies like that do very well. Good omni-channel retailers. This so far this year, Dick's Sporting Goods has done a great job. First, we sort of switched over to single-person sports, and now you're starting to see team sports come back. And just remember some of the, on the broadening pharmaceuticals, even, there's a lot of focus on healthcare with coronavirus, and appropriately so. But that doesn't mean drug development hasn't continued to happen. So, companies like AbbVie have just kept plugging along and doing what they need to do to continue to grow.
And Stephen, we've been talking a lot about yields in this and how it's kind of changing the landscape for investors, but also on the consumer side, we got the update in University of Michigan's Consumer Sentiment Survey, and that reading jumping to a year high, the highest we've seen since March of last year, the pandemic just getting kicked off then. I mean, what do you make of maybe how the stimulus, that $1.9 trillion coming through into consumers' pockets is going to change things moving forward when it comes to how the underlying economy is expected to perform?
Yeah, I mean, I think we'll certainly have to be mindful of the possible inflationary impact of all this stimulus. That being said, we think the immediate numbers, the year-over-year numbers, may look a little more distorted on inflation than they will in a few months. Because you remember, this time last year there was a lot of disinflation. There was a lot of drop in inflation as we were all sort of hunkering down a bit. So the numbers may look a little higher right now than they are long term. That being said, if you look at equity markets over a long period of time, if rates are rising, the 10-year between now and 3%, but if they're rising because of economic growth and improved prospects, that's not necessarily bad for the equity markets. So it's something we'd want to be mindful of. That being said, you can get some good, nice, steady companies with dividend yields that are secure, that are a lot higher than you're going to get in the Treasury market right now. And we don't necessarily see rates running off just yet, but certainly something we have to keep in mind as we go forward.
So what's the level that you're looking for right now? If we're looking at the 10-year sort of an indicator of things running a bit hot, 164 right now, what's that level where you say this is a bit of a warning sign?
We don't think we're there yet. So we're comfortable where we are now, and it's not so much the level, but the why. So if rates are starting to move up because the economy is growing but not overheating. So we don't necessarily have an absolute target, but it's the context around that movement that we'd be mindful of right now. Because one of the interesting things is businesses, a lot of the technology, like things we're using today, we weren't widely used a year and a half ago. So we think there's going to be a lot of productivity that could offset increased costs. So it's something we're going to have to be mindful of. In fact, if you look at the S&P fall off in earnings on this, going over long periods of time, despite everything that happened with the healthcare crisis over the last year, the fall off in S&P earnings was much less dramatic than you would have expected, because there was that productivity. Businesses were able to pivot and get done what they needed to do. So we think it's really not a number, but kind of a context or an overall picture of what's going on, if that makes sense.